TD, and also the figures which are given there, they are in million of shillings, so we need to indicate that our figures are in million of shillings, in million of shillings. Yes, so let's go to note number 1. In note number 1, what are we told? We are told that the company has available for sale financial asset with a carrying amount of 80 million and financial asset at fair value through profit and loss of 40 million. And then you're told both financial asset reported losses in the fair value of 8 million each as at the end of the year. Now, in that case, we are given two categories of financial assets. So first of all, we have the available for sale, for sale financial asset. Now, the available for sale financial asset, these are abbreviated as AFS. And number 2, we are also given financial asset at fair value through profit and loss. Financial assets at fair value through profit and loss, So first of all, you're given their carrying amount. Carrying amount is never a charge here because this always will be given. So carrying amount for the available for sale financial asset, that is given as 80. And for the financial asset at fair value through profit and loss, that is given as what? 40 million. So basically, I've said that is never a charge in these questions. The charge is determining what we refer as a tax base. Now, what we need to remember here is that the tax base, what I've said here is that is the value or is the amount of an asset or liability for tax purpose. Usually, in case of this particular financial asset, they are supposed to be reflected, or basically they are supposed to be reported in the statement of financial position at their fair value. This is therefore the fair value, but the tax base is always equal to the cost. Is always equal to the cost. And what we are told, if we go back to the last paragraph of note 1, is that both financial assets said reported a loss of 8 million. Of 8 what? Million. So mean that if they reported now a loss of 8 million, that means that for us now to know their cost, the cost which was incurred by the company in terms of acquiring them, we will take now, like in this case, we take 8 million. And because there was a loss, we add back the loss. Because if the fair value was 80 million and they reported a loss of 8 million, that means that there was a decrease in the fair value from the cost which was incurred. So therefore, the cost in this case will be 80 million. We add back the loss, and this will give us 88. And the same concept will apply here. We take 40, we add back the loss of 2, and that will give us 48. So then from there, we get now the temporary difference. We go back here. We have said that temporary difference is basically carrying amount minus tax base. So we take this minus that, which will give us -8. This minus this, which will give us -8. And if we get a negative figure here, or if we get a negative temporary difference, this is always known as deductible. This is always known as deductible temporary difference. In the same case, because that is a negative, that is deductible temporary difference, which is usually denoted as T, not T, rather DTD. DTD, that is deductible temporary difference. Deductible temporary difference. So that is it. We move to note 2. We are told inventory is shown at the roll of cost and net realizable value. The cost is 3,200, and while the net realizable value is 3,120. So that is a simple. What you are given there is inventory. Now, what we need to remember here is that according to IAS 2, which governs now the valuation of inventory, Inventory, according to this standard, should always be valued at the roll of two values. One is the cost, or Roman 2, the net realizable value. So if you go back to that particular information, you'll see that you're given the cost of inventory as 32. We are given the net realizable value as 3,120. So the value of the inventory should be the roll of the 2. Definitely, we should be 3,120. 120. That is the value of the inventory which will be taken or which will be reported in the statement of financial position of the company. So therefore, the carrying amount for inventory is that 120